Hi, today I am going to talk about unrealized profit in a consolidation. Unrealized profit, how it happens. When there is intra-group sales, we know in a consolidation there are parent-subsidiary relationship. There can be parent and several subsidiaries, or parent will become a subsidiary itself and there can be one or two parents itself. These relationships can exist and the intra-group sales happens. When the intra-group sales happens, the members trade within each other. They trade with each other. Parent can sell it to subsidiary, subsidiary can sell it to parent, subsidiary can sell it to subsidiary. These relationship and these trading activities can take place. Then the selling party will be keeping a profit margin with the other one. If parents is selling to subsidiary, parents will keep a profit. So subsidiary selling to parents, subsidiary will keep a profit. So with these profits are normal when there are independent entities. When they are independent entities, they try to make profit for themselves. But when they are in a group relationship, the group as a whole is considered as a unit, one single unit. So the group as a whole has to sell it to the outsider to realize the profit. When they sell within themselves, that means the group members sell within themselves, then the profit element is not realized until they are sold it to the outside party. So if there is any goods remains with any of the any of the group member unsold to the outside party, bought from a other member of the group, then there is an unrealized profit. This unrealized profit has to be eliminated in consolidations because otherwise the income and the assets are overstated. Retained earnings overstated and assets will be overstated because it's lying within the inventory. So we have to eliminate that. To prepare a consolidated financial statement which is giving you relevance and faithful representation. So we will see a sample how it happens in reality. We will see P. It's a parent company, sells it to S. It makes a profit of 8,000 and S keeps 60% of the inventory with it, unsold, to an outside party. So P has made the profit, okay, 8,000. But 60% of the inventory is with S. So 60% of 8,000, 4,800 is still with S, unsold. For the group, this has not realized. So we have to adjust the inventory. Inventory cost, inventory for the group cost we have to take. The inventory should be displayed at the group cost. And at the same time, the profit what P has earned also has to be reduced because it's not realized. So P and S we have to adjust. P is retained earning and S is inventory. So how do we do it? We do a consolidated adjustment. Debit the retained earnings, parents retained earning, and credit group inventory. So it gets eliminated both ways. So now after elimination, the stock will be at cost and the retained earnings also will show the real picture. Suppose this is P selling to S. Suppose S is selling to P. What happened? S is selling to P, same thing happened. S is keeping the profit and its retained earning has to be reduced. And P's stock, the group inventory, because I'm talking about group inventory, because when we are taking the inventory in the consolidated financial statement, we add S plus P. So it becomes the group inventory, and the group inventory, that 4,800 is there. So we have to remove that. So we do a consolidated adjustment. Subsidiaries retained earning is debited and credited the group inventory. But when we are reducing the subsidiaries retained earnings, we have to be a little careful, and we have to note that subsidiary will have NCI component. If the P doesn't own 100% of S, if P is owning 80%, 75%, 60%, then what happens? The balance is the NCEI. So the unrealized profit also has to be apportioned between the parent and the NCEI. So 4,800 will be apportioned if it is 80%, 80% to the parent and 20% to the NCEI. This adjustment has to be done in the consolidated financial statement. So how we are going to do it? I am going to explain to you in a worked example. We will see a worked example. During the year, I'll read the question from the beginning. We bought 80% of S 2 years ago. At the date of acquisition, SS retained earnings stood at 16,000. So that means we had to, when we are working out the goodwill, we had to take the retained earning at the time of acquisition to find out the net assets of S at the time of acquisition. So during the year, S sold goods to P 20,000, which gave S a profit of 8,000. Okay, it has sold with a profit of 8,000. P still hold 40% of these goods at the year end. So here S is selling, P is holding the stock. So S is going to make the profit, P is having the stock unsold about 40%. So 40% of 8,000 will become your unrealized profit. 8,000 total profit. What happens? 40% unsold. So 3,200 is remaining in P's inventory. So we have to make a consolidation adjustment. So how we are going to make it? Unrealized profit, we will take it. Total profit transaction is 8,000. 40% unsold. So 3,200 is your unrealized profit. So how are we going to make the consolidation adjustment? Consolidation adjustment, we can do it in two ways. One is we can straight away debit consolidated retained earnings of S, and then from there we can split up into 80% to parent, 20% to NCI. Otherwise, we can do it alternatively. We can do it straight away. That is consolidated retained earnings, we are taking the 80% which belongs to the group. That is 3,200 into 80%, 2,560. NCI is 20% of 3,200, 640. And you credit the group inventory. So you are eliminating the unrealized profit. So now we will see the other workings. Other workings are goodwill. Before calculating the goodwill, we had to calculate the net assets of the subsidiary. Asset summary, at the consolidation date we should know, and at the date of acquisition we should know. Share capital is 30. Retained earnings 56. It is 56 at the time of consolidation. This is 31st December 20x1. We are consolidating. At that time it is 56. At the date of acquisition, we assume the same share capital would have been there. And 16,000 they had told you in the sum. 16,000 at the time of acquisition. It has got the retained earning. So the total is 46,000 is the net asset value at the date of acquisition. But this 16,000 at the date of acquisition has grown as 56,000. That means post acquisition you have made a profit of 40,000. That is the indication of that. Now when we are totaling up the total consolidation, we had to take out the 3,200 from this 56,000. So 82,800 is the net asset value at the date of consolidation of S. So now we will see how the goodwill is calculated. We will see how the goodwill is calculated. We will see cost of investment 50,000. Then NCI at acquisition. Here we are not taking the fair value of NCI. We are taking the net assets value proportionate share, 20%. So this is a partial goodwill, 9,200, because the goodwill doesn't contribute to NCI. 59,200, and you take the net asset value 46,000. We calculated at the beginning 46,000. So that was taken, and the goodwill is 13,200 we have calculated. Then we have to calculate the non-controlling interest. When you are calculating the non-controlling interest at the date of acquisition is 9,200. Then the post-acquisition we saw it is 40,000 above. We calculated that is 40,000 here. That 40,000, 20% is 8,000. Then again we had to reduce the PURP, that is provision for unrealized profit. We are deducting that 640. And the non-controlling interest at the date of consolidation is 16,560. Then finally, we had to see what is the consolidated retained profits will be. We had to take all of the P's retained earnings. It is 200 according to the independent balance sheet, 200,000. For that, we are adding the share of S's post-acquisition profit. That is 40,000 into 80. Within this, the unrealized profit is there. So we are removing that. Alternatively, we can reduce the unrealized profit from the 40,000 and share it between NCI and the parent. Same figure will come in whatever way you do it arithmetically. So now our retained earnings at the consolidation date is 229,440. So now we do a consolidated balance sheet. P Group consolidated statement of financial position 31st December. Goodwill we have worked out 13,200. Then the PPE line by line adding, there is no change. We are adding 100,000 parent, 41,000 subsidiary. Same thing. Other assets. You see in other assets, inventory is included. So we are doing a line by line addition, 110 plus 50, and deducting the unrealized profit within the group inventory. It is lying in the group inventory in the P's stock, P's inventory. We are removing that 3,200. So this is 156,800. Then the total is 311,000. Then we see the share capital. We are taking only P. And the consolidated retained earnings we worked out 229,440. And non-controlling interest also we worked out 16,560 after adjusting the unrealized profit within the retained earning of group retained earnings as well as the non-controlling interest. We have removed the unrealized profit component. Then the current liabilities is a line by line addition. There is no change. We are adding 10,000 and 5,000 liabilities. So 15,000 then the balance sheet or the financial position balances. This is how we adjust the unrealized profit. So I hope this is very clear in your mind. If you like the video, please subscribe for it. We'll meet another video very soon with the other adjustments in consolidation. So until then, bye bye.